Traders Corner is brought to you by IG.
Welcome back. You're watching Traders Corner, and as always, I'm joined by Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, we've been moaning about a lull in the markets for so long now, and all of a sudden, volatility seems to have returned. No doubt people are going to moan about that too, but what do you make of it all?
Yeah, it is interesting because you're right. Every week I come on here and I say, oh, we're going to start with the S&P 500, and it hasn't changed for the last 7 weeks, which had been the case. But this week it's different. It has changed a little bit. And you can see the graph that's up on the screen at the moment. And this is obviously our bigger picture look at the US markets before we bring it home and have a look at the local setup. So what's quite interesting to note is the fact that this lateral support level at 2160 on the S&P 500 was broken to the downside on Friday night. You can see also there's a gap in the chart over there, which implies that the US market gapped lower at the open on Friday. Now, obviously, on Monday, yesterday, we did see a big rally to retrace some of those losses. But the fact of the matter is that this 2160 level is a very, very important line in the sand now, because that was important support holding the market up. It's broken below that level, and now it seems to be bumping up against the underneath of that, what is now resistance. So we need to see what happens at 2160 and whether the market fails at that 2160 and continues to drift lower into the sort of September, October period, or alternatively, whether it actually manages to push back above that resistance and continue higher. And what's also interesting to note is the Bollinger Band. So I know I've come on the show every week and I've said, look, the Bollinger Bands are tightening and they're getting tighter and tighter and tighter.
Yeah.
This window at the bottom pane of this graph here is the Bollinger Band width, and it was down to 1% wide, which it was the lowest that it's ever been, ever, right? And I said, it's not going to stay like this. It will expand at some stage. And usually when you get your Bollinger Bands contracting like that, it results in a big explosion of volatility. So you can see the bands have now begun to widen over there. And obviously your Bollinger Band width has begun to widen as well. So chances are this does imply that we've got the beginning of a bit more volatility beginning to happen on the markets.
And I suppose that's illustrated by the volatility index, the VIX.
Yes, that's right. So this chart is the VIX. This is the Chicago Board Options Exchange Volatility Index. It's a measure of implied volatility on the S&P 500 options. And what you can see is that the way the VIX works is that when markets are volatile or when markets are sort of fearful, then volatility pushes higher. So you can see, for example, at the end of June there, notice how volatility pushed up, and that was around the Brexit event. Okay, and then it's been very, very dull, very low volatility throughout July, August, and into early September. And now all of a sudden we've had a big push up in volatility over the last 2 days. And that's been brought about by comments, or lack of comments, I suppose, out of the ECB last week, Thursday, where Mario Draghi didn't announce any additional stimulus, which is what the market was kind of hoping for. And then also we had a couple of hawkish comments out of the Fed officials, which suggested that maybe there's a chance of a September rate hike, although I think that's unlikely at this stage. But basically, these things came along and they rattled the markets a little bit, and hence the uptick in volatility.
Well, and followed swiftly by dovish comments from one of Lael Brainerd,
Lael Brainerd,
the Fed members. So that sort of soothed markets a bit.
It did. But you know what this really tells me, though, is that it just goes to show how addicted these markets are to stimulus and to this low interest rate environment. Because as soon as you get just the slightest whiff of a suggestion that we might get a hike in September, and oops, maybe the ECB is not going to stimulate more than what markets were already factoring in, the markets have a little tantrum. And it just goes to show how drugged up these markets are on this stimulus and on this low interest rate scenario that we find ourselves in. And it's worrying, because basically the stimulus that's being pumped into markets, as well as this low interest rate and negative interest rate environment in some parts of the world, is creating asset price bubbles. And equity markets are richly priced. And if you take away that stimulus or you start to raise interest rates, what's going to happen? It's certainly, and what the events of the last few days have just shown to me quite clearly how dependent these markets are on the drugs that are keeping them happy.
It really is a ridiculous state of affairs, having this kind of bipolar market, because as we said last night, if you raise interest rates, it's a good sign, surely. But anyway, we'll talk about that in a little bit. But I mean, the stimulus of the past, 8 years has been extraordinary. And yet you've got a chart of seasonality in the S&P 500. And this is actually quite a sort of a recurring theme in the S&P, to have a bit of a wobble and then to have sort of heading into October and then to pick itself up heading into the end of the year.
Yeah, it's quite an interesting chart, this. And this is from a crowd called topdowncharts.com. You can see them referenced at the bottom there. But basically what this is it's a historical pattern of the daily movements of the S&P 500 since 1990 up until 2015, so 25 years worth of history here. And the black line represents the historical pattern average, obviously, over those 25 years that the S&P 500 typically follows throughout the year. So you can see strong first couple of months leading up until about May, and then very sideways, choppy, nowhere kind of action throughout the Northern Hemisphere summer months, and then you get a dip in October and off to the races again from October until the end of the year. That's been the historical pattern for the last 25 years. So if you look at the red line here, that is basically showing you the S&P 500, how it's traced this year. And quite honestly, you can see it's tracking the seasonal pattern. As it has done in the past. There's no difference, really. So if this is to be believed, and if we do continue with this type of pattern, then what we could see is a bit of weakness into October, and then that'll be your buying opportunity for a year-end rally, if we believe that this pattern is going to continue to play out for the rest of the year.
And what about the JSE? Because, I mean, you have a fairly negative positioning, if you like, on the top 40. And I know you've got a fairly sort of interesting chart that you want to illustrate this week.
Yeah, this is just, again, this is the chart of the top 40 index. This goes back to March of this year. What's notable, again, we've said this dozens of times, but again, we repeat it. This 45,000 lateral support level is very, very important on the top 40 chart. And you can see that the market's by and large gone sideways throughout the year, which made it a bit frustrating. Last week on the show, I pointed out the fact that we had this shooting star candle, which often demarcates a short-term top in the market. And I said that if that pattern was to be believed, then chances are we're going to go a little bit lower. And that's exactly what has happened. We've seen the market retracing a bit since last week when we got that shooting star pattern. Also, what's quite interesting to note is the diamond patterns. This is a technical pattern that we don't often talk about on the show, but the reason being that they're not actually that common. But this year, there's actually 3 of them that have been evident on the top 40. And you can see we've had one very recently, which has played out now over the last 3 or 4 weeks. And then back in May, we had another one, and in April, we had another one. And both of those prior occasions, those did mark a short-term top in the market. And those diamond patterns broke to the downside. Now, they don't always break to the downside. Sometimes your diamond structure can be a continuation pattern if it continues out the top. But so far, this one's broken out to the bottom as well, which suggests to me that we might actually be in for a period of a bit of weakness still, and maybe we come back down towards this 45,000 lateral support area again, and then we see whether that support holds and whether that's a buying opportunity for the end of the year. But you mentioned that I've got a sort of a bearish outlook on the market, which I don't have a bearish outlook, but I'm positioned in the sense,
rather, should we say?
Yeah, because I don't know whether I'm bullish or bearish. Quite honestly, I'm a bit confused. And I think if you look at that chart, which goes sideways, you can sympathize with why it's confusing, because it could go either way from here. But we've got an option structure on, which gives us participation to December now.
Yes.
If the market trades below 46,500, we've got put options which will benefit us in the event that the market does go lower. So what that allows me to then do is, if we do see weakness now into the end of September or into October, like the seasonal chart suggested as possible, if we see that weakness, then what it would do is allow me to buy the market for a year-end strength, knowing also that we've got this option structure which protects us to the downside anyway.
Yeah.
So as things stand right now, I'm kind of sitting back and I am waiting for the market to do its thing, and if I see weakness now in the next couple of weeks, then I will probably look to buy that weakness, knowing that we've got an options protection on the downside.
I mean, if you saw weakness, it would come too late for the option structure that you had built for the September futures closeout, which is of course this week.
Yeah, we do have another option structure on which expires this Thursday, and that has a put option with a strike of 45,000. So it would mean that the market has to fall about 1,500 points between now and Thursday, and it needs to fall further than that, actually, for us to make any money. So chances are we're going to kiss the premium goodbye on that option structure. It's not the end of the world. It's an 800 Rand odd that we paid away. It's nice to have that downside protection in place, though, but the reality is, because the market's been going sideways this year, we haven't profited from any of those option strategies. But if there comes a time where the market sells off hard, we will participate in that downside by virtue of having these options protection strategies on each quarter.
Yeah. Well, and speaking of the quarter, Garth, got a nice chart up there to illustrate who's done well, or which sectors of the market have done well and which haven't.
Yeah, we're going to quickly look back at the last quarter, because when I say the last quarter, we're talking about the futures quarter. So this is the 15th of June, which was the last futures closeout.
Yeah.
And up until now, the 15th of September this week is this next futures closeout. So we kind of review the quarter that's gone by now. And this is the makeup of all the different indices of the JSE. So what's interesting to note is the top 40 only up about 0.5% in that time, so very basically gone nowhere. But there's a bit of discrepancy in the sectors, and you can see mixed performances. Industrials slightly down, resources up 5%, not a bad performance there. Financials basically flattish, gold up. But now look at the banks and the retailers. This is quite interesting. And it's interesting because often you'll find banks and retail shares do tend to move in the same direction. And this quarter, they've gone totally in the opposite direction. We've got the banking index has actually been the best performer of the major sectors in this quarter, up 10%. And that's even after we've had the recent shenanigans with the Hawks and Pravin Gordhan and what have you. So the banks were up even more than that at one stage, a few weeks back. And then at the bottom, really bringing up the rear, we've got the general retail index, which is down 5% for the quarter. And that's following very weak trading updates from Mr. Price and from Truworths. Book build in SPAR. Woolworths hasn't done very well. So by and large, your retail sector's really been the dog in the last quarter.
I mean, if I were sort of a betting lass, I'd say maybe the banks are going to follow suit. Unless, of course, you could say that what's ailing the retailers is already in the banks. Priced in the bank.
Yeah, it's possible. Look, I mean, I think we'll need to see what risks lie ahead for us in the rest of the quarter. But certainly retail and consumer spending has been under pressure in the last quarter.
And Garth, those are the overall indices, but I know you've got a couple of charts which actually show the top 5 and the bottom 5 contributions to the top 40.
Yes, so this came out of a report from Investec this week, and I have to credit them for that, for the work that they've done here. But this is very interesting. It basically takes the top 5 and the bottom 5 shares in the top 40 index and shows you how many points they contributed or deducted off the value of the top 40 during the last quarter. So the top 40 index itself is in the middle there, that added 740 points throughout up until the 9th of September this is. But now have a look at the contributors. I mean, Naspers it added 1,100 points to the value of the top 40 in the last quarter. All right, and then you can see Anglos and Billiton added a bit more there, Standard Bank. And then right at the bottom here, you've got SAB Miller, which effectively took away 522 points from the value of the top 40. Mr. Price, with its massive hit that it took over the last week or two, only dropped 67 points off the top 40 index. And the reason for that is because Mr. Price carries a very small weighting in the top 40. It sits right at the tail end of the top 40 index.
Yeah, and of course SAB was a completely different story towards the first half of the year because of the currency.
That's it. Very much a Rand story there. So because the Rand has by and large been stronger in the last quarter, SAB Miller's come under pressure.
Garth, I know you want to talk about event risk for the last quarter of the year. We'll have to whisk through that.
Yeah. So we're now obviously moving into towards the fourth quarter of the year, and what are we looking out for? So there's just a couple of things locally that we can keep an eye on. Locally, the political shenanigans keep going. You know, is Pravin Gordhan going to be arrested? Are we going to get more headlines around the Hawks and Pravin Gordhan? Probably. I doubt that that's gone away completely. There's a December ratings downgrade, which is also in the wings. It probably priced in to some extent, but that'll be a big talking point in the fourth quarter. Big for the market is that the SAB Miller deal will probably reach its conclusion, and that SAB Miller will be removed from the top 40 index. And that's going to mean that stocks like Naspers, for example, that already have a very big weighting in the index, are likely to carry an even bigger weighting after that. And then offshore, we've got the US interest rate debate, which will continue. Will there be a December rate hike? And then finally, the US election will Donald Trump win, heaven forbid, or will Hillary Clinton win? But that's obviously going to be a theme that's going to be very closely watched in the coming quarter.
Yeah, it's kind of a race between the ugly sisters. Garth, so what does the portfolio look like? Unchanged, I imagine, from last week.
Still up 15% year to date, 288,000 Rand in the portfolio. This September option structure will expire this week, Thursday, and then we'll only have our December contract, which we will continue to run out to the end of the year.
And then just a reminder, people can subscribe for a weekly email.
Yes, if you'd like to find out what's coming up on the show each week, you can subscribe. Go to traderscorner.co.za and go to the middle of the page, and you'll see there's a link there for a free weekly email. Enter your details, and then you'll get an email once a week on a Tuesday telling you what's coming up on the show for that week.
Okay, great. Garth, we'll leave it there. Garth McKenzie is founder and editor of Traders Corner.
Traders Corner is brought to you by IG.